2017 is looking like President Buhari's lucky year. If you're looking at his first 4-year tenure, now we're at halfway, what you call the midterm, and it looks like 2017 looks like his best year so far. He came in 2015 with a lot of baggages of the previous administration, and then before he could hit the ground running, President Buhari and his team were hit with a massive meltdown of the economy in 2016. Then we started January, oil prices started recovering, and all forecasts look really good. We touched about $65 a barrel. Then he's got his hands on the Niger Delta community and the restiveness there to be quiet. Then he got lucky again with the OPEC and Russia deciding to give Nigeria an exemption from oil curbs. So it looks like it's President Buhari's time for some sit back, have some champagne. And again, he put all his debts, his financial people on the street to do a couple of things. Then he got lucky with the U.S. holding the rates down and investors looking for emerging markets to invest. So he got lucky again on Broad Street now, but he has to do something very quickly. While oil money is still pouring in, his FX reserves look very decent. But it's not time yet to hold a party, as some folks are saying on Twitter. There's still a lot more to do. So we're discussing President Buhari's debt strategy. The strategies by his debt managers, the MOF, the Debt Management Office, and the central bank. Those are the three main drivers of this. Robert Tomato, the head of research at Afrinvest, still here in the studios. So I've mentioned a few of the drivers of this current debt direction. But again, there has to be a strategy here for investors, whether they're and asset managers, and how to take advantage of what is going on. I'm talking to the local guys first. Let's lock out the foreign guys for the moment. Let's make this a family affair. So how do I trade and profit from this new Buhari's debt strategy direction?
Thank you. That's a very good question. And it's good to look at it from the perspective of what happened in the market between 2016 and 2017. You know, because of the desperation of the central bank, for example, to manage the foreign exchange market and the liquidity that tracks that market, you saw the guided rates upward, which was where we had the boom in the fixed income market locally. You know, that a lot of banks and, of course, retail and HNI investors were able to take advantage of that market in 2016 and coming into 2017. And now these rates are beginning to trend downward. We are already having single digits. You know, if you look at the trades that happened yesterday, we saw some maturity of about 91 day, you know, trading at a single digit, you know, in terms of
8.55,
yes,
8.58.
Exactly, in terms of interest rate. But coupled with that is the fact that you also have an equities market that, you know, is already picking up because, of course, foreign investors who are usually the drivers of the market are in the market, and then we have the local bandwagons, you know, who are also taking advantage of the fundamentals, you know, happening. 2018 is not going to be the same story. So for investors who still want to play within the fixed income market, you know, the smart thing to do, because right now you're seeing rates are already trending downward. You know, there are still few opportunities to take within the bonds market, you know, where you still have average yield hovering at about 14.4% across the benchmark instruments, you know, with a possible inclination of investors towards buying longer dated instruments, you know, and the fact that the drivers of the short-term instruments are not ready to continue to support that in terms of supply, the likelihood is that you will now see a lot of attraction moving towards the longer dated bonds, especially, you know, and the import of that will be that as rates are trending downward, the value of investments begin to go, you know, upward. So investors, especially who currently have, this will speak to mostly fund managers like the PFAs, who have long-term funds, you know, it makes a lot of investment sense to begin to pitch within the longer dated instrument, you know, with an expectation of yields going downward. Even if MPR remains at 14%, that is, if the central bank, the Monetary Policy Committee refuses to, you know, taper rates, what you will still see is that the funds that are tracking the long-dated instrument will force yields downward. And, you know, and that means a very good investment for those who take position. From the if you allow me, from the short-term end of the market, especially those who are buying into funds, what funds will be doing, especially money market, mutual funds, especially who are tracking, the money market instrument, will be trying to be active, within the market, because as these rates are going downwards, for example, if you have bought your treasury bills at, say, 16%, as these yields are going downward right now, what you tend to see is the appreciation in the value of your investment. Perhaps if you take advantage of that and you sell down in the market, you have higher value than you came into that investment. Yeah. But of course, if you hold to maturity, you get the value, the par value as at the time of investment.
So that exit door is where everybody's front loading now.
Correct.
Trying to go in there because you don't want to hold to maturity.
Mm-hmm.
So,
then,
so the strategy from President Buhari's team is to force folks to get out of that door.
Well, for me, I think...
because if you hold to maturity, you're going to get 8.5%. But if you get out now, you get your 16%. Again, depending on the secondary market.
The perspective here is that it's not so much of a Buhari strategy, but... I mean, from the perspective of the supplier, what they are doing is...
And the supplier is the central bank.
Simply put, saying, I'm refinancing my debt, right? Now, refinancing your debt means that you're paying down on some of your debt instruments that people are already holding,
yes.
And then people deploy the funds into alternative investment windows,
yes.
But if I am in this investment, because remember is that it's not all the treasury bills outstanding that are going to be paid down.
Mm-hmm. You understand? The treasury bills is still heavy.
Exactly. We still have heavy investment in that window.
Yeah.
So if you get out of that window at currently the ones that are maturing, the unlikelihood is that most investors will not buy into instruments that are currently trading at single digits. So we begin to see some scarcity within that window where investors will still continue to track the high yielding, maturity.
Someone would have to fill that gap. And some folks are saying CPs and CBs, corporate bonds and commercial papers from corporates will likely feel that. This is all part of a strategy one way.
Well,
President Buhari and his team are getting choked by the day.